Mortgage loans are long-term loans secured by real estate property, typically residential homes. Borrowers repay these loans through periodic payments that include both principal and interest. Mortgages are fundamental to housing finance because they allow individuals and businesses to acquire property without paying the full purchase price upfront. Traditional fixed-rate mortgages maintain constant interest rates and payment amounts throughout the loan term, while adjustable-rate mortgages, ARMs, periodically reset interest rates based on benchmark indices. Mortgage lending is a major component of banking activity and plays a critical role in economic growth, consumer spending, and financial market development. The program emphasizes mortgage finance because of its importance to financial institutions and systemic risk management. Fixed-rate mortgages provide predictable payments and protect borrowers from rising interest rates, making them attractive during periods of low market rates. Adjustable-rate mortgages initially offer lower interest rates but expose borrowers to payment increases if benchmark rates rise over time. ARMs became particularly significant before the global financial crisis because they expanded access to housing finance but also increased default risk when rates reset upward. Mortgage loans are typically amortizing, meaning borrowers gradually repay principal over the life of the loan. Lenders evaluate borrower creditworthiness using factors such as income, employment history, debt levels, and credit scores. These underwriting standards are essential for managing default risk and maintaining stability within mortgage markets. The development of mortgage-backed securities, MBSs, transformed housing finance by creating a secondary market for mortgage loans. Instead of holding mortgages until maturity, lenders can pool loans together and sell them to investors through securitization. Government-sponsored entities such as Ginnie Mae, GNMA, Fannie Mae, FNMA, and Freddie Mac, FHLMC, purchase mortgage loans and issue securities backed by mortgage cash flows. This process increases liquidity in mortgage markets and allows lenders to originate additional loans by freeing capital from their balance sheets. Mortgage-backed securities therefore connect housing finance directly to broader capital markets and institutional investors worldwide. Mortgage-backed securities distribute mortgage cash flows, including interest and principal payments, to investors. Pass-through securities are the simplest form of MBSs because they pass mortgage payments directly to investors after servicing fees are deducted. More complex structures, such as collateralized mortgage obligations, CMOs, divide mortgage cash flows into different tranches with varying maturities and risk characteristics. These structures allow investors to select exposures based on desired risk-return profiles. Mortgage-backed securities are highly sensitive to interest rate movements because borrower refinancing activity changes expected cash flow timing. Consequently, MBS investors face both interest rate risk and prepayment risk, making valuation and risk management more complex than for traditional bonds. Prepayment risk is one of the defining characteristics of mortgage-backed securities. Borrowers often refinance or repay mortgages early when interest rates decline, allowing them to secure lower borrowing costs. When prepayments increase, MBS investors receive principal repayments sooner than expected and may be forced to reinvest funds at lower interest rates. Conversely, when interest rates rise, prepayments tend to slow, extending the maturity of mortgage-backed securities and exposing investors to greater interest rate risk. This asymmetric behavior creates negative convexity, meaning MBS prices do not respond to falling interest rates as favorably as traditional bonds. Effective prepayment modeling is therefore critical for evaluating mortgage-backed securities. Prepayment modeling attempts to estimate the likelihood and timing of early mortgage repayments under different economic and market conditions. Models consider factors such as interest rate levels, refinancing incentives, borrower credit quality, housing turnover, geographic mobility, and seasonal patterns. Conditional prepayment rate, CPR, and Public Securities Association, PSA benchmarks are commonly used measures for evaluating prepayment behavior. Because prepayments significantly affect cash flow timing and valuation, accurate forecasting is essential for investors, banks, and risk managers. Mortgage-backed securities are often valued using Monte Carlo simulation techniques that incorporate multiple interest rate scenarios and prepayment assumptions to estimate expected cash flows and option-adjusted spreads. The global financial crisis of 2007 to 2009 demonstrated how weaknesses in mortgage underwriting and securitization practices can create systemic instability. Excessive reliance on subprime mortgage lending, inadequate risk assessment, and overly optimistic assumptions regarding housing prices contributed to widespread defaults and severe losses on mortgage-backed securities. Complex structured products amplified contagion across banks and financial institutions globally. In response, regulators introduced stricter mortgage underwriting standards, enhanced disclosure requirements, and stronger capital and liquidity regulations for financial institutions. The crisis highlighted the importance of understanding mortgage risk, securitization structures, and prepayment behavior in maintaining financial system resilience and investor confidence. The program highlights mortgage finance, mortgage-backed securities, and prepayment modeling as essential areas of fixed income and credit risk analysis. Mortgage markets are deeply interconnected with banking systems, housing markets, interest rate dynamics, and broader economic conditions. Understanding mortgage structures, securitization processes, cash flow modeling, and prepayment behavior is therefore critical for financial professionals involved in portfolio management, banking, and structured finance. Mortgage-backed securities provide valuable investment opportunities and liquidity benefits, but also introduce complex risks related to interest rates, borrower behavior, and market volatility. Mastery of these concepts is essential for effective risk management and financial stability analysis in modern capital markets.